Hey everybody, this is John, and welcome to the free video. And gosh, Twitter had quite the earnings. They doubled expectations. They made a penny instead of 2 pennies. You can see here we closed at 38.59. Expected move was $4.10. We're currently trading at 49.90. I think we got as high as $52. So it's trading about 2.5 times. That is a big move. So for tomorrow, how I play this now, I did not buy a bunch of call options here with the idea that it would go up. We did try to buy a pullback here. I tried to sell a straddle, did not get filled on it. And of course, now if you do sell a straddle like that and it shoots up to your level like this, then after hours you can just buy. If you sold one, you can buy 100 shares, and then you've got your hedge in place. But for tomorrow, typically what happens is on a big move like this is that it does not come down. Okay. You don't expect something like this and then it collapses, because what happens is on the gap up, not only do you have new buyers, but you also have short covering, and that kind of keeps a ceiling. So you literally at the open can just short wherever it opens. It'll if it opens at 50, start selling the $50 puts, but even better, sell the $45 puts, because at the open the implied volatility will still be pretty high, but I'm expecting that it will hold. Okay. Now, one other thing that you can do here, and I was talking about this a little bit in the room, is that the NASDAQ futures, you can see right now they're trading at 39.56 or so. What's interesting is that the futures, for whatever reason, and I've noticed this, and I don't actually understand why they do this, they actually have a delayed reaction to this. Now, guess what? If Twitter is up 25% after hours, Amgen's up after hours, what's going to happen is other NASDAQ stocks are going to kind of catch a rally on this. And guess what? There's a very high probability that the NASDAQ futures will gap open tomorrow. And what I have found is in situations like this, you can actually buy, for those of you that trade futures, I think they'll reopen here shortly, but you can buy them tonight, around 39.57 or so, and they may open up around 39.65, 39.66 to reflect the price action that we're already seeing. Now, obviously, Twitter by itself isn't going to drive the NASDAQ, but what happens is whenever one of these companies has really good blowout earnings, it kind of lifts all the NASDAQ stocks. And so what I do on stuff like this is I'll buy those after hours, and then in the morning, even just before the market opens, just sell them. You're just kind of looking for a scalp. Anyway, so that's kind of fun. The other thing here that I want to talk about, because I've been getting a lot of questions about this, is just in terms of trade structuring and things like that. So here's a position that we have. It's TTWO, right? And on this one, it's a little unusual. We've got a weekly squeeze here. We didn't have a daily squeeze, but you can see we did hit that 1272 extension, which is a place to take profits, right? Feed the ducks. And now we're pulling back. And one of the things I found a lot of times is I am a huge believer in two things. One, well, three really. Scaling in and out. Okay, so a trade is not, when people first learn trading, they learn the absolute wrong thing. It's, you buy a call or whatever it is, you buy a call and then you got to target and then you got to stop, and that's it. Okay, that's the worst way to trade. It's the lowest probability way to trade. The more you understand options, of course, the more you can actually structure your trades to win. And because the death of options trading is that right here you load up on calls and it trades sideways and you lose money, and it wasn't if you had the stock you wouldn't have lost money. If you bought at the money options, you could lose 100% of your investment if it was like a weekly option. So a big part of this kind of science of trading is understanding, one, how to leg in and leg out of a trade. Okay, well, first of all, understanding that you should be doing that. Secondly, understanding how to structure a trade to get the best results. So what I mean by that is that, for example, this is 2-2, as I call it. On this one, it wasn't so much just buying calls. It was buying some out-of-the-money near-month calls and then some in-the-money further out calls, and then offsetting that with some in the money near month calls, as well as some puts in the front month. And so you can see on something like this where we hit the 1272 extension yesterday, great, take some off and book those profits. And then today with the remainder, you can see though that even though it was a down day, look what's still positive, okay? You can see all the positions that are still positive and then the one that's actually gone underwater. But if you structure this trade correctly, what's going to happen is that you're going to have a situation where you take profits at targets, okay? You take profits at targets and you have options at this point that would have gained the most in this move, but would also lose the most in the pullback. So you dump those. It's fine to hold on to the rest of it and look to see if you can get actually the next move higher. Okay, on something like this, if you just buy a call here, then suddenly you're underwater. But if you do a combination of buying calls or selling puts or adding iron condors or adding calendars and constructing a trade in such a way that you can actually scale out of it, be theta positive, etc., then what's going to happen is you are going to have more winning trades. And then if you also know that if you do, like say, have a weekly squeeze, what is the best way to structure it? Okay, so if you've got a weekly squeeze versus like say a 39-minute squeeze, what are the differences? Which options are you going to buy or sell to take advantage of that setup? And that's really kind of more the the art and science of trading. And the better you understand that, essentially the more money you're going to make. So this is a subject that's near and dear to my heart. I'm going to be doing a webinar on this on Thursday, July 31st. That's 8 o'clock East Coast time, which of course is 7 p.m. Central. And the link to sign up is simpleroptions.com/pro, and it's essentially how to trade options like a professional. And you guys have probably been seeing me doing more of this in the room. I kind of hesitate to go all out because I know that there's, I don't want to confuse people, but if there's a 78-minute squeeze versus a 195-minute squeeze, that's going to be a different way to structure a trade with options. And also it's going to depend, if like all the waves are above zero or if the B wave is below zero, that's also a different way to structure the trade. And so what I've found in doing this over the years is the best way is just like, look, if you've got like a 78-minute squeeze and you got these three things going, then the highest probability way to structure this trade so you can make a profit on it would be X. Because remember, if it's a bullish play and it goes straight up, that's great. Everybody wins. But what happens if it pops up and then implodes? What happens if it trades sideways? Okay. What happens if it gets almost to its target but doesn't quite get there? That's the reality of trading. This is great when this happens, but we also know that the percentages of that happening clean every time is on the lower end of the spectrum. You might get a trade setup that works 75% of the time, meaning that initially it'll go higher, but does it go exactly to the target that we want? Does it have a head fake? When do you cut and run? And you can actually structure a trade in such a way so that it really doesn't matter. Okay, and anyway, that's what I'm going to be talking about in the webinar. So if we go through the bullet points here, see, it's what I've discovered about professional options traders that they don't want you to know. And you'll see me sometimes in the room kind of, I call it screwing around with the market makers. They essentially do kind of hate it when that happens because you're cutting in front of them, but that's there's some strategies that you can incorporate with that. The idea of option stacking to structure your trade in a way that gives you the best possible odds of success no matter what happens. Okay, how to plan your trading position around a setup instead of the other way around. Why structuring your trade as a campaign around a setup will yield the maximum return while reducing risk. And then how to be proactive in your trading instead of reactive. And a lot of that has to do with defending your trade as well and knowing the best way to do that. Okay? So I'm going to go through some of this stuff. Again, this Thursday, July 31st, 8 o'clock East Coast time, 7 o'clock Central, free webinar, first name, email address. Hit register now, and you'll get the details. Looking forward to sharing that with you guys. Have a great night, and we'll see you at the next update.